All righty. Good morning, good afternoon, everyone. Thanks for joining us today. My name is Bella. I'll be your host for today's webinar, Operating and Retirement Strategies for Business Owners. A few quick comments here before I hand it off to Quentin and Claire. This webinar is being recorded and it'll be made available on our website under the resources tab and also posted on our YouTube channel. You'll get an email when it's sent out with the link as well there. There's a few poll questions that we asked you guys, some statistics, just to get your mind on the subject here. Take a moment and answer those before we get started. We'll reveal those answers kind of throughout the presentation today, so you can be listening for those there. And at the end of this webinar, we'll be doing a Q&A session. So please use the Q&A feature at the bottom of your screen to ask your questions, and Rachel and Carrie will be answering those questions for you. All right, without further ado, Quentin and Claire, if you'd introduce yourselves and we'll get started.
Thank you, Bella, for that introduction. My name is Quentin. I'm an advisor here at KWB. I've been here for about 7 years, actually, this month. So we're excited to do this webinar. I've got Claire here.
Hi, everyone. My name is Claire. I've been with KWB for a little bit over a year now. I'm a recent graduate from the U of R, and this is my first webinar, and Quentin is my boss, so the pressure is especially on. So I'll just go ahead and give it over to him, and we'll get started.
All right. Thank you, Claire. So we get a lot of questions when it comes to, running a business, how to structure it, and even down to the retirement planning. So today we wanted to run through some of the common questions, kind of get those answered for you. And one of them was the benefits of incorporating. And, a lot of times what we hear is, hey, I heard if I incorporate my business, I can avoid some taxes maybe. Well, that's not necessarily true, but you might get some opportunities as far as, how you structure your income and how you're taxed on it. Then, once we decide maybe we want to incorporate our business, take it to the next step, we got to pick which entity structures right for us, which tax filing status is the best one for us. And so we get those questions a lot. The other thing after that is, I've established my business, it's running pretty good. I want to start saving for retirement because I know as a business owner, saving for my retirement is really up to me. And so we'll dive into those kind of options for you as well. And then, hey, I'm saving for myself. My business is growing. Now I've got employees. I want to help them out. Or I know that in California, we do have a mandate that we'll talk about later, where if you have 5 employees, you got to start doing something for them or offering something as far as a retirement plan. So to answer these questions, we've got kind of a little bit of a roadmap here for you. We're going to talk about the factors to consider when structuring your business. What should we be looking at as far as taxes, maybe how our income flows to us and the different strategies that we have. Then choosing which business entity might be right for us. Do we want to go beyond the sole proprietorship, expand into an LLC, maybe an S Corp or a C Corp? And then from there, we'll talk about the retirement savings options, all right? What you have as far as maybe California's the bare minimum kind of thing or full-blown 401k. Then we'll dive into just some key takeaways to leave you with, both you depart and kind of thinking about maybe your business or someone else that is growing in the ways that we've mentioned today. So the factors to consider right from the get-go when we talk about, setting up your business, deciding if you want to be just a sole proprietorship or go all the way to maybe a C Corp, or first tax savings. So like I mentioned, we hear a lot of times, hey, I could avoid taxes by setting up an LLC. Not necessarily, but the way you get taxed could be different. And there's different strategies that you could set up with your team of CPAs, your financial advisor, to kind of maximize your income. Then there's administrative responsibilities we got to be thinking about. Yeah, sure, it might sound cool. Let's become a full-blown corporation, and then realize, oh, we have filings that we have to do with the state and the IRS. We have to have boards of directors and different requirements that just take more time to meet and even more money as well. So that drives us right to cost. Some of the things that we need to consider is how much does it cost to set up these various entities and maintain them? And then the income that we have. What is our income source? What kind of business are we running? depending on what income we have, how much income we're going to have would also determine how we set up our business and choosing an entity. And then control. So some entity structures, you know what, sole proprietorships, you got a lot of control, a lot of flexibility. Gradually, as you move into some of the higher level entity structures, you lose a little bit of control because you have to answer to other people, but you still have a lot of flexibility in how you want to run your business. And then the final one here is personal liability. We hear this one a lot, you know, personally liable maybe for accidents on the business or for debts that are held against the business if you have any loans, and what your options there as far as protecting yourself from those liabilities. We're going to jump into the sole proprietorships here and partnerships. And we're kind of lumping these guys together because they're basically the same. The only difference really is that in a partnership, you know, there's more than just one person. There's two or more people acting together and operating the business. So we're going to go through the pros and cons of a sole proprietorship partnership kind of structure, with the assumption, though, that if you are a partnership or plan on creating a partnership, that you and your business partner get along, you agree on business decisions, and you're in it together. Because oftentimes I can hear, hey, if I have a partnership, I got to deal with the other person. That in some ways could be a con there, but that's specific for the partnership. So pros and cons. So complete flexibility here is a pro, because you know what, you kind of get to run your business as you see fit. Yes, there are some restraints that you have. You have to make sure you have business license depending on where you're operating and the kind of business you're operating, but you kind of get to run it with the accounting, different things as you wish. Then there's the potential for extended credit. So you could actually get potentially more credit for your business because you're personally liable for the business and its debts. The bank could say, hey, yeah, your business, maybe it's younger, doesn't have a lot of capital or anything like that, but you as an individual could have a house and other assets that the bank could lean on in the event that you weren't able to make good on your payments. And you receive all business profits. So everything flows through to you. There's no other levels or layers of the corporation. It just all comes directly to you, makes it fairly simple. Then there's the ease and the ability to start and maintain. So sole proprietorships, like I mentioned, really, you just need to make sure you have a business license, you got a company name, you're meeting any other little requirements maybe that there might be, but they're relatively easy to start and get going. And then they're easy to maintain because there's not a bunch of corporate filings or anything that you have to do along the way. And because they're easier to start and maintain, they're also less expensive for that reason. The cons here, though, would be that you're personally liable for all business debts. So while it might help because the next potential, or I'm sorry, it could help because that you're liable because you could get more credit, but by being more liable, it just puts your business and you at risk. Then it could be potentially harder to get bank loans. So if you don't have personal assets there to back up your loan that you're trying to get, or you don't have the business income and the history, it could be harder to get a loan as well. Finally, last con here would be that selling the business could be a bit of a challenge. It's easier to sell a entity style business where the entity owns the different assets of the business, has its own accounting, it's kind of separate from an individual. So that just makes selling of the business easier, more straightforward. But let's say we wanted to add protection and incorporate our business for maybe some other opportunities. Well, your options here are going to be the C corporation, the LLC, and the S corporation. Right away, I'm going to go ahead and just rule out the C Corp because it isn't always the best option for your small business. The reason this is because of the double taxation where, hey, your corporation has to pay taxes at its corporate rate, and then any of the earnings, all of what's left is passed through to you, where then you would have to pay taxes on it as well. Then they're also complicated to set up and maintain. There's more paperwork, documentation, you need a board of directors, different levels of things that are required of you as a C corporation owner. You might, though, consider a C Corp if you have really big growth plans that you say, we're going to need tons of capital, we're going to grow this thing. Well, then in that event, you might want to start out and maintain a C corporation status so that you can maintain capital inside of the business and deploy that as needed as you're growing. The other reason you would need it is if you became a business where you had more than 100 employees and you had a larger number of shareholders as well, then you would want to consider the C corporation status. You can always change your filing status at any time. Just because you select an S Corp or an LLC now doesn't mean you couldn't become a C Corp later. And if you selected C Corp now, doesn't mean you couldn't change to an S Corp or an LLC down the road as well. You can always kind of change those. There are separate processes, though, for making those adjustments. All right, so the LLC and the S Corp. They're a better option for small businesses because we have better protection. There's than the sole proprietorship and partnership. They're a little bit less complicated compared to the C corporation, and they have some better taxation strategies potentially, depending on your income and the type of business that you don't get in the sole proprietorship and in the partnership model. When we talk about protection, okay, LLCs and S Corps kind of reduce the limited or the personal liability that you have for the business debts. So the bank won't go after you, your home, or anything like that necessarily. The reason they would is if you personally guaranteed a loan or co-signed on it. So what a lot of times happens is a bank may not give the business a loan. So the business owner says, okay, well, can I personally guarantee it? Well, right away there, you've lost the protection of the LLC because you have personally guaranteed the loan. But it does help you if your business is younger, you don't have maybe the revenue, the income to back up the loan that you're trying to get, then it would be something that you would want to consider. But just remember that it would give up that protection that we seek with the LLC and the S Corp structure. LLCs and S Corps, they're less complicated and they have more flexibility compared to some of the other options. And what do we mean by that? Well, they're easy to create. An LLC, basically you go online, you get you yourself becomes the registrant, you file your business license, you pay your fee, and you're good to go. You've got your business, your LLC created on a very simplistic model. Then you get to choose how you want to be taxed. So you could set up an LLC and be a pass-through entity, or you could be a sole proprietorship or a partnership. So you could get that protection of the liability and some of those other things, but still be taxed as a sole proprietor if it made sense for your business and how your income was structured. On the S Corp side, they're a little bit more complicated than the LLC. You do have some other corporate filings that you have to do with the state, and you can do all of that online. You also have to have a board of directors for your business as well. There's no choice of really how to structure your taxation here, how you would be recognized. You're always going to be a pass-through entity. And in the long term, there are more requirements compared to the LLC. So just on the tax side, a few more things that you have to be aware of. All right, so California has their own special tax structure for LLCs and S corporations. And basically for an LLC, you have to pay $800 a year and a minimum in an annual filing fee, basically. Then if you make more than $250,000 a year, if your business makes more than $250,000, there's a structure very much like the tiered tax structure that we're used to, where the more you make, the higher the change in the percentage. So you pay your $800 and then you pay that additional fee based off of how much income your business produces. On the S corporation side, there is a tiered structure as well. Most S corps though fall into the 1.5%, and it's really their structure for tiering it is based off of the type of business that you are. So if you're in finance or banking, it's different than just the traditional business maybe. but most S corporations fall in the 1.5%. And they do have, again, this minimum annual tax of $800. So no matter what you're looking at in California, you're going to be paying at least $800. Now, we have to talk about reasonable compensation. This applies to both LLCs and S corporations. Basically, reasonable compensation is the IRS's way of testing, hey, what would you pay somebody to do your job if you couldn't do it? So if you couldn't physically do what you're doing today, would you pay somebody $50,000, $60,000, $100,000 a year to do it? Okay, if that's what you would pay them, that's what you need to pay yourself in W-2 wages. Basically, they don't want you paying everything out of your LLC and S Corp to yourself in distributions. And to be honest, really, as financial advisors, we probably would recommend that you not do that as well, because it will impact your retirement savings abilities and strategies. So when we get into that in a minute, depending on how much you're paying yourself in wages could determine how much you can put away for yourself for retirement. The other thing too is if we pay through everything through in distributions, we're going to impact our Social Security because we won't actually be paying FICA taxes, and that would reduce the amount that we could potentially get in Social Security later. So you kind of want to balance that fine line of how much do I pay myself in wages, make sure I'm meeting that reasonable compensation number, and then the rest of it could potentially be in distributions. So getting into the taxes and how to determine maybe how income flows to you. In an LLC, if you set it up as a sole proprietorship or a partnership, gets taxed the same way those guys do. You pay self-employment tax, FICA tax at 15.3% on the first $147,000 in wages. For this reason, most LLCs elect the S corporation status, filing status, so that they can have some pass through to the owner. So they might have some wages and then pass through the rest as distributions. Now, not all LLCs, though, pay self-employment tax. If maybe you're in real estate and you've got rental properties where you're primarily not the management company, you do not have to pay self-employment tax. And as well, this also applies to those LLCs where you are maybe not an active participant in a business, where the LLC maybe holds a position in another company. S corporations, they're a pass-through entity. So you determine what you want to pay yourself in wages. Whatever you pay yourself in wages up to that $147,000 is taxed at self-employment tax rates, that 15.3, but then the remainder of it can be passed through to you in distributions. So that's where you just kind of work on those numbers, kind of figure out how much you want to pay yourself in wages and figure out what the distribution would be thereafter. To kind of give a very simplistic strategy example here, I'm going to say that a business owner has $100,000 in income. If we had $50,000 as in W-2 wages, we would pay $7,650 in self-employment tax. We could write off $3,825 of that as a deductible expense for the business, and then the additional $50 is passed through as a distribution to the owners. And there's no self-employment tax on that last $50. Now, if you were a sole proprietor, you would be paying $15,300 in self-employment tax, and you could deduct about $7,650. So you can kind of see where, depending on the reasonable compensation and how much income you need, how much income the business has, you can kind of adjust what you pay yourself in wages versus a distribution and kind of work around those self-employment taxes. So California did something in response to the Tax Cuts and Jobs Act back in July, a little over a year ago, July 16th of 2021. Basically, they passed AB 150 and this rule applies to all pass-through entities or qualified pass-through entities, where you can pay 9.3% of your income tax through the business. So if whatever you would be paying yourself in distributions, you're going to have income tax on that. You can pay 9.3% of the income tax on those distributions through the business. By doing this, you reduce your income in the eyes of the IRS. So it doesn't reduce your income on the state. You just say, hey, maybe I had $100,000 in income If I pay my 9.3, I get to reduce that, but I still pay it based off $100,000 in California. This was designed to help with the SALT deduction. So, before we could deduct, in California, our state and local taxes are higher than some other states. So we had a higher deduction maybe that we do not have anymore. And this was California's response to that. To give a simplistic, again, strategy for this and how it might look, the 9.3% tax rate for a married couple, you would be somewhere in the $61,000 to $312,000 in income. So if we assume that you're filing married, you have $50,000 in W-2 wages and a profit distribution of $200,000, that puts you in the 9.3% bracket. Before AB 150, your taxable income would be that $250,000. But with AB 150, you could reduce your pass-through income by $18,600. Now the IRS is taxing you based off of $230,000 versus $250,000, which then would save you about $4,400 in your federal income tax. So this is a strategy that you would want to make sure you kind of talk with your tax professional before implementing, but it has helped a lot of business owners when it comes to their federal income tax. So something definitely that you would want to consider. The only other thing on this is if you do decide to use the AB 150, once you start, you have to stick with it. You can't change halfway through the year. So we've talked about the different structures, the LLC maybe versus the S Corp. You might be wondering, okay, well, which one should I choose? That's going to very much depend on you, your personal situation, the business that you have, the income that you have. But to kind of break it down into simplistic terms, an LLC, you would want to choose this if maybe you have no plan, so you don't plan on selling stock or seeking venture capital. An LLC can't have stock shares to purchase. And you would choose the S Corp filing status most likely in order to give yourself that flexibility. And then if you're involved in real estate, then this would be the option that you would want to choose, the LLC. Now, if you are planning on selling equity to outsiders or other employees, then you would want to go to the S Corp filing status in order to be able to do that, as well as if you plan on seeking additional capital, maybe through venture firms or something along those lines. So LLC pretty much fits for everybody. That way you don't have to have some of the other requirements. You can just do the LLC standards and file as an S Corp. So we talked a lot about the different entity structures and options that you have. Now we're going to dive into the retirement plans with Claire, kind of understand how those work and in line with some of the entity structures that we've reviewed.
Thank you, Quentin. And yeah, as Quentin discussed, there are a lot of things that go into planning for your business, whether you're starting one, whether you currently have one. But also another huge part is that we want to talk about the retirement planning as well. It's important to understand when you're starting your business, how are you going to save for when you want to end your business or when you kind of eventually, want to retire and, plan around, your savings and what you want ultimately. And also, whether it's just yourself and you have employees, it's important to understand what options that you have for retirement savings. There are many things that can go into which plan that you choose for your business. There are tax benefits. Making contributions for yourself and also for your employees can reduce your taxable income and save you on that tax side. There are also savings goals, depending on how much you want to put away is really going to depend on the plan that you choose. For how much you want to plan to put away for your employees, if you want them to fund their own retirement, you want to contribute to that, and also for yourself and potentially your spouse. And also, it's a way to attract and retain employees. A recent Forbes study said that 62% of people are deciding on a job depending if they have a retirement plan for them or not. So it's really important that if you have one, it's important that you have the right one for yourself and for your business. And also if you don't have one, that you consider putting one into place. And that kind of goes into the next point about the retirement plan mandate that California has in place, which we'll get into in the next slide. But as of June 30th, 2022, if any business has more than 5 employees, it is a requirement that there is a retirement plan in place. If you do not currently have one, the first option and the requirement is that you enroll in something called Cal Savers. This is a California state-sponsored retirement plan for your employees. It is a Roth deferral only. For all those that do not know what the Roth means, this is after-tax dollars going into the plan. It grows tax-free, meaning there is no pre-tax deferrals. There is no way to get that tax-deferred growth. There's great options with the Roth. However, this is the only option that you have with the Cal Savers. It is completely employee funded, meaning the employer is not obligated whatsoever to contribute to their employee's plan. This is only if you do not currently have a retirement plan in place and you have more than the 5 employees. However, there's been, a lot of talk that in the next coming years, it'll probably go to if you have at least 1 employee that you will have to have some sort of retirement plan in place. So even if you do not have the 5, it's important that you consider starting to implement it. It's an auto enrollment. You are required to go online and register each of your employees into the system. And it's a $6,000 max contribution, very similar to a traditional IRA or a Roth IRA. The biggest thing to note for anyone who's listening out there is for the hefty penalties. If you have more than the 5 employees and you're not currently signed up or have the retirement plans, it is $250 per employee for the first 90 days. And after 90 days, it goes up to $500 per employee. So depending on your structure of your business, how many employees you have, that can be a pretty hefty penalty if you do not have a current retirement plan in place for them. This is going to be the best option if you want to have, the least amount of effort and you're just trying to get a plan in place to avoid those penalties. But of course, we want to recommend that you do something obviously more for yourself and more for your employees. And that's why we have all the other options that we're going to talk about today. This gets into our first option, which is the individual K. This is my personal favorite for anybody that is self-employed and you have no employees other than potentially your spouse. This is going to be the best plan for maximizing your contributions at the fastest rate that you possibly can. The reason for this is that the funding of this plan is both the employee and the employer, and it recognizes you, the business owner, as both. Therefore, you're able to do the profit sharing contribution as well as the employee contribution. This is where it kind of gets really picky depending on which plan you want and your contribution limits as far as what you can do on the employee side and as well as the employer. The total contributions combined cannot exceed $61,000 or $67,500 if you are age 50 and older. It does allow for that catch-up contribution with the individual K, whereas most other retirement plans do not, other than the 401k for the 2022 tax year. However, each year this does go up, of course. From the employer side, this is going to be up to 25% of compensation up to the maximum of the $61,000 for 2022. And from the employee, this is the big thing to note in this, it's 100% of earned income up to a max of $20,500. So no matter what, 100% of your earned income up to the $20,500. Whereas many of the other retirement plans that we're going to talk about, it has some sort of income threshold percentage on the amount that you as the employee can contribute to your plan. But at least on the employee side, it's always 100% of your compensation. So obviously the max of $61,000 between both the profit sharing and the employee. This is one of the best plans that you can do for really being able to put away a lot for yourself and potentially a spouse. But if we're going to show kind of the pros and cons of this, and one of the biggest cons that I want to talk about is that this is going to be limited to one person. So if you plan on growing your business, as Quentin kind of discussed, there's many things to think about, when you're incorporating, but also when you pick your retirement plan as well. So if you have, if you decide your business is growing, you want more than one employee, then you're not going to be able to continue to make those individual K contributions. Then, the other con is that it does have a little bit of a higher cost. Annual reporting, it's harder to set up than maybe other traditional retirement plans, but it's still a wonderful, great option that, of course, we can help you with. And the pros, it's the highest contribution limits that you can get other than the traditional 401k. Other than other options, there is the Roth option. This is not really offered in, the SEP or the Simple. So that's a really big thing that you should consider. And it's one thing that most employees are looking for when they are picking a retirement plan, because we're in our lower earning years when you are younger. or even as a business starting out. So it's important to understand where your tax bracket is going to lie and how you can really take advantage of that Roth option. So it's something that if you really want that in your plan, you really need to consider which is going to be best for you for the retirement planning side. Is obviously there's tax savings. Everything that you contribute to your plan is going to be tax deductible, and you're going to be able to benefit from, if you decide on that pre-tax as well, that pre-tax growth to tax deferral. There's the catch-up contributions, whereas other plans do not allow it as much. And also it's flexible. If one year maybe business is not doing as great as you expected, or maybe it's doing better than expected, or life happens, maybe we can't contribute as much as we want to our retirement plans, but you are yourself are in complete control of how much you want to contribute, and you have no sort of obligation to contribute for anyone else. Exactly. So that is one of the biggest pros, I think, of the individual K. However, as I said, one of the biggest cons is, of course, if your business is growing, you cannot continue to still have the individual K. So now we're going to go ahead and move into, our next retirement plan option, which is going to be the SEP IRA. The SEP IRA is going to be a great option for any self-employed individual or small business owner. You can, even if you are by yourself and it's just your spouse as the employee, you can still have a SEP IRA. However, when you're looking at it based on the SEP IRA and the individual K, it's probably better to go with the individual K if you are by yourself. But of course, if you do have employees, then you're not going to be eligible for that individual K. So the next option that you have is the SEP IRA. The biggest thing here is that it is employer funding only. The employees do not contribute whatsoever to their retirement. Every business is completely different. And maybe, you as the business owner know your employees best. So it's important to realize maybe if you have a plan where they're not going to be able to contribute a lot, maybe this is a good option for you as well. The contribution limits, it's between 0 and 25% of compensation, and also 20% for self-employed. So that's just something we're going to get into in a minute, but it's important to understand, as Quentin already discussed, the difference between, the proprietorships and the LLCs and the S Corps of that 25 versus the 20%, because it can make a difference. Up to the maximum of $61,000 for 2022. So it's the same maximum contribution as the individual K or maybe the traditional 401k. However, you are locked into that percentage of your compensation. So if you only make 100,000, then you can only put, if you're 20% self-employed, 20,000 into it. That's just something that's really important to understand from a salary standpoint. And as Quentin also discussed, what you pay yourself as far as what you're going to put in for as a business owner on the employer side. And also the biggest kicker with the SEP IRA is that each eligible employee must receive the exact same percentage. For example, if you contribute 20% to your plan, you make 100,000, that's 20,000, and the next person only makes 80,000, it is 20% of 80,000. So depending on what you're paying your employees, that's going to determine that amount that's going to be contributed to their plan. It is the same percentage across everybody, and you are locked into that for at least a year. And maybe the next year you decide to change it, maybe lower, maybe higher, but you are locked into that percentage. So it really is going to depend on what you're paying your employees, and there is no dollar amount. You can't just say, I want to put 5,000. It is a strict percentage across the board. So that is just something that is really important to consider, and that I think gets kind of lost in the works of the SEP IRA, and it can be a really big problem depending on what you pay your employees on the annual basis. But as we get into the pros and cons, the SEP IRA, it's super easy to set up. It's very inexpensive. It's a very, easygoing plan. It has higher contribution limits than a traditional IRA. A lot of people think of a SEP IRA as a traditional IRA, but for employees. The traditional IRA, the max contribution is going to be 6,000, 7,000 for the catch-up. But here you're able to put away a lot more depending on that salary. It's an employee benefit. We talked earlier about attracting and retaining employees. Considering it's employer funded only, this can be a huge driving point for employees deciding to join the plan. Maybe they're not liable for helping contribute, and that's something that they really appreciate. People really do like it when you're caring about their financial future. That's been a huge trend as far as the job market going as well. And it's flexible contribution years to an extent. If you contribute for yourself the 10%, you also have to do the 10% for everybody else. But, maybe one year you want to contribute 0%. That it gives you that flexibility within the year. But as we kind of go into the cons, that, as I discussed, it depends on that salary, and depending on what you contribute for yourself, you're locked into that for the year. Also, the two other biggest cons is that there's no catch-up and there's no Roth, whereas I just talked about with the individual K, you have both those options. And I think that those are big factors, especially if you are over 50, because it can make a huge difference for maximizing those contributions a lot quicker, especially if you, the business owner, are over 50 as well. And then there's no employee contributions. I think that a big benefit of offering a retirement plan is that you are encouraging your employees to contribute to their retirement plan as well. So this can be a con for some people, but a pro for others. So it's just something to consider when you are choosing if you would rather have maybe a SEP IRA versus a solo 401k. But now, as we'll get into, your next option is something called the simple IRA. And this is going to be very similar to the SEP. It's self-employed, small business owners, any business with 100 or fewer employees, very small business based. And it's different from the SEP where it's employee and employer funded, whereas with the SEP, it is only employer funded. The contribution limits are going to be higher than traditional IRA, but lower than something that you could do an individual K or a SEP. It's 100% of compensation. So that's the difference between this one, especially, and the SEP, is that it's that 100% versus the 0 to 25 or 0 to 20. 100% of compensation up to a max of 14,000 and the 17,000 for the catch-up. It does allow for the catch-up here. It's not much, but a little bit can go a long way. 14,000 is still a decent amount. So maybe if you have a plan and you're not wanting to put away, that 61,000, or, this is going to be a good plan for those that are just wanting to kind of start small and maybe go bigger later on. 14,000 is still a lot more than 6 or 7 each year. And this is the other part that's really, really important to consider with the simple. The employer has to contribute. So the employee may contribute, the employer must contribute. And you have two options for those contributions. Option one is a dollar for dollar match of employees' contributions up to 3% of their compensation. Obviously, that does depend on their compensation, but it is a match, which I think is a really great incentive for employees. And option two is a contribution of a fixed 2% of each employee's compensation every single year. Well, it doesn't have to be every single year, but for the year. When we were talking about this and saying, what's better, option one or option two, the general consensus was option one, because it's encouraging employees to help fund their retirement. And also it makes you look good as the employer because you're contributing, A, rewarding them for contributing, and B, you're helping them along the way with their retirement, which helps bringing both sides in to maximize those contributions for the retirement savings. It really can depend on what you want. Maybe one year you choose option two if employees are maybe starting out small, they're not making as much, and then maybe you go to option one in the next year. Either way, you can pick, you have to choose annually, and you can decide, depending on your business structure and what's best for you, which one you want to do. But either way, you are locked into that for the year. So business, a lot of people think with COVID, your business may have kind of a downturn. It doesn't matter. You are still required to do that for the year. So that's just a big thing to consider. And now to kind of get into the pros and cons, as with the SEP, it's very easy and inexpensive to set up. Employees share responsibility for their retirement. I think that's one of the biggest pros of this, is that, it's great if you, the employer, are helping them, but also you want them to, be motivated to A, stay, and B, to help contribute to their plan. And then also there's a catch-up provision. There's not this with the SEP. It's not much, but as I said, a little bit can go a long way. The cons, it's lower contribution limits. As I mentioned, there's no Roth option, which is super important. The employer must contribute, and then you're locked into that contribution choice. It's hard, I think, sometimes to consider which option may be best for you. But as I said, just depends on what you want for your employees and also for yourself as far as that goes. So now we're going to get into something that you all are probably familiar with, which is just the traditional 401k. This is going to be best for people that are, farther along the way as far as what they want to do from a business standpoint. You're planning on growing your business, and you just need a little bit more of an organized plan that's going to help with your growth. So plan eligibility, this does differ for everybody, but I think the general average plan eligibility rules are that you're 21 years of age and that you had to have worked at least 1,000 hours in the previous year. As I said, this really can change. I've seen it be 18 years old. So just, it really depends on what you want, and you have the flexibility to design that in your plan. The funding is employee and employer, as I'm sure most of you know. The contribution limits, same as, something kind of for the solo 401k, but the total employee and employer contributions cannot exceed the lesser of 100% of employees' salary, or $61,000. So it does allow you to put away, a very large chunk of money if you're just doing this traditional 401k. For the employee, it's 100% of their compensation up to $20,500, $27,000 if age 15 older. And then for the employer, there's many, we could have gone into the many different, plans that you can have and the flex there, but however, there's so many different contribution formulas that you can do. You can do a match, you can decide not to contribute at all, you can change it year by year. A common one is just the matching percentage up to the 3% of employees' compensation. I read an article also from Forbes that said that 75% of people are choosing the job based on if there's a match or not. So that's another thing to consider too, is that you're helping employees with their financial future, depending on what you do for that contribution formula. So even though you have a 401k, if you're not necessarily helping the employee, that may be, something that they choose not to go with you for. So it's just important that you choose a contribution formula that is best for you, for your business, and also for your business cycle, depending on how much money you plan on bringing in and helping with each eligible participant. But now as we get into the pros and cons of the 401k, it's going to give you the highest level of salary deferrals, whereas with some of the other plans, you don't necessarily have that option. The recruitment and retention, I feel like I've kind of, emphasized that point. I think everyone is looking for some sort of retirement plan. The most common, of course, the 401k. There's tax savings and credits. There are more expenses that go into the 401k. As a business, you can deduct those from a business expense. That administration, as far as the contributions on both the employee and the employer, that's going to help you with that tax saving side. That's something that is super important to you. And also the catch up in the Roth. That's something that, is not offered in all plans, but of course in the 401k. The cons, it's annual reporting. There's a higher cost for record keeping, investments, administration. And one of the biggest things is that there is an annual audit for plans of 100 or more eligible participants. A recent example that we had was a franchise business, lots of turnover, but there were a lot of eligible participants. And because that plan had more than 100 people, that annual audit can cost a business up to $15,000. It's pretty expensive. So as a business owner, if the cost of setting up the 401k is going to be a big con to you, it's something that you really need to consider before implementing that. It's also just a huge time management thing. It's not, you can't just set it up and, set it and forget it. You have to continuously maintain the 401k or have people that are helping you do that. It's harder to set up. And also with the cons, it's a pro and the con with the matching contribution formula. It's a great thing to offer, but also depending on what you choose, you are locked into it, no matter how great or bad business may be, or no matter, what employees may be doing to their plan. If you decide on that matching contribution, then you are eligible for doing that. However, if the biggest con to the 401k is the cost, there is another option that has recently become very popular, and that is our next slide, called the pooled employer plans. This is going to be the exact same features of a 401k. Nothing different regarding that. However, it allows for unrelated businesses to participate in one 401k plan managed by a pooled plan and provider, PPP. It's going to be best if you have over 100 eligible participants. And this is what I was talking about in the previous slide, because you're going to be able to hopefully reduce that audit cost. If you have under 100 employees, there would be no benefit of doing a pooled employer plan because you wouldn't have to get that annual audit cost. And therefore the biggest con of the 401k would be that cost, and you wouldn't have to do that with the pooled employer plan. So if you have more than 100 people, then a pooled employer plan may be good for you because it's going to have every single person, every single business in that plan sharing in that one audit cost for that business. So that's something that, that biggest con for the 401k, consider the pooled employer. It's going to give you the economies of scale, but as we'll get into the pros and cons, it's going to give you less control. With the 401k, you can customize it to exactly how you want, maybe with investments, maybe with plan eligibility, if you want the Roth. With the pooled employer plan, you're not going to have as much control. It doesn't mean that you can't have the things that you want, but you're not going to have as much options to pick from. So it's less customization as far as the con side. And the investments are more limited than a traditional 401k. As I said, it doesn't mean that you don't have good options. It's just that you're more limited. So if investment, allocation and how the options that you have is a big importance for you, this may not be the best plan. And you also get no choice of record keepers. This is a big one because it can completely structure how you do payroll, how you decide that you want to structure part of your business with that. So if that's also another issue as far as, your business structure, that's something to consider as well. But with the pros, it's less administrative burden. You're essentially, the economies of scale with more employers. So it's not you alone managing it. It kind of reduces the risk of having to manage all of that. And then it achieves the economies of scale and it reduces the cost. That is the number one pro of the pooled employer plan, is that it's going to reduce your cost if you have over the 100 people. Because if you have under 100 people, then a traditional 401k is going to be your better option. So that kind of concludes the retirement plan summaries. Every option has pros and cons to it, depending, as Quentin already talked about, how you structure your business is going to depend on how you choose your retirement plan.
Thank you, Claire. So before we jump into the questions, we just have a couple takeaways that we wanted to share. The first one being that when we talk about the business entities and how you file your taxes, whether it's pass-through, sole proprietor, to just really make sure that you evaluate and think through the pros and cons of each kind of solution, and consider the legal protection, the tax treatment, and then some of the requirements as far as reporting and the board of directors and different filings. The second takeaway here is when it comes to choosing the retirement plan for your business, that you should do some research and see what options are available to you and your employees. Here at KWB, we set up retirement plans for business owners and help them through this process. We ask you all kinds of questions to really dive into how much you're looking to put away for yourself, how much you want to do for others, and give you kind of the best or different options for you to choose from based off of those answers that you give us, so that we can really kind of align the plan with whatever your goals and ambitions are. And then finally, when you're doing all of this, it's really best to kind of have your tools in place, and your tools would be the business lawyer, maybe the accountant, and a financial advisor to just kind of help make sure you get everything lined up appropriately, all your ducks in a row, all the things that you need to make sure that each piece of your business is interacting together properly. And with that, I'll see if Rachel and Carrie have any questions.
Thank you, Quentin, and thank you, Claire. That was very enlightening. Lots of stuff to think about for sure. I know we get a lot of questions over the years as far as the different kinds of retirement plans and whatnot. And I think another thing just to chime in there, after listening to the presentation, is sometimes we have, doctors or dentists and other maybe professionals that really want to get aggressive at saving. And there's another option where you marry it with these plans, I think called the defined benefit or the cash balance plan. How often have you had the opportunity to set up kind of a marriage of those plans, like with the defined benefit cash plan? And then how aggressive could somebody actually begin to, put money away for their long-term retirement?
Yeah, so we've set those up quite frequently, where we, evaluate, what you're looking to save. If you're looking to put away more than than what you're allowed to in the individual K or 401k, we can, work with your company, whether there's multiple people or just yourself, and figure out, okay, based off of, what everyone's salaries are, everyone's income, and determine, what the amount you can put away is. Because sometimes what happens too is, hey, you might, depending on, the employees that you have, how much you're paying them, could impact how much you can put away for yourself, if you didn't have employees.
When you start thinking about a plan, what do you think the most important thing to, articulate to figure out what kind of plan is appropriate?
I think when it comes to setting up choosing the right retirement plan and figuring out which one is appropriate, is really asking yourself what you want to do for your employees, especially if you have employees. Because depending on which plan you set up, could determine how much you're going to be on the hook to make sure that you do for yourself and for them. If you don't have employees, then it's really pretty simple as far as really how much do you want to put away for yourself. If you want a lot, put away more than the 6,014, makes the next options a lot easier. If you're looking at your employees and saying, well, I want to make sure that I maximize for myself, but maybe make sure that they have skin in the game as well, then we would start to look at things like the 401k and maybe doing a match versus the 3% mandatory contribution. So you really need to be thinking about what it is you want to do for yourself, and if you're doing it for yourself, what are you willing to do for others?
And also, just to chime in on that too, it also is going to depend on what you think that your employees can do as well. If you're going to go through all the work of setting up, a 401k, but you're not going to have any sort of plan participation, even if you offer the greatest match ever, it's still not going to matter. So I think it's important to understand, what can your employees do for themselves as well? Because even if you choose a SEP, that's just the employer funding. It's not going to matter what necessarily the employee wants. So I think it's really important to understand how much do you think that they can contribute, and also how much are they going to participate? Because even if they're eligible, doesn't mean that they're going to actually participate in the plan.
Yeah, lots to think about if you're an employer, whether you're self-employed or an employer, lots of different options. But I think the main thing is it looks like you guys know the options and people can come to us. And I think there's one more option we've done, which is a non-qualified plan, which is just deferred compensation. We didn't even talk about that in this meeting today. But hey, guys, I'm really interested in knowing the poll results. What happened? What did people elect?
Should be showing on the screen now. The first question: what percentage of people consider the availability of a retirement plan when deciding to take or remain at a job? The correct answer, Claire mentioned, it was 62%. So it looks like it was pretty, everyone went for 45%, but 62% is that answer, right, Claire?
Yes, that's true. And also, there were more stats that I wanted to include, but yeah, 62% of people consider the availability of a retirement plan when considering to remain at a job. And also, it's higher too for people that are wanting to stay because they still have a plan and they're getting that match. So, there's a lot of people that have retired, but it's like, maybe I'll work for a few more years because I'm getting that match and I can just contribute even more to my plan. So that's just a big thing for people that are staying at jobs, going into jobs, and also continuing to work.
Perfect. And then the second poll question was, how many new business licenses were submitted in 2021? Quentin, I can't recall if you mentioned that. You remember the answer?
I didn't, but I believe it was 5.4 million.
Yep, that's correct.
Yeah, one of the largest years that we've had. We'll see if that goes on a decline here into 2022 as people realize it takes a lot to run a business, as many of you know.
I think one other interesting statistic is, as employers, people are saying, well, it's really hard to find workers. And one of the thoughts had been that a lot of people after COVID started waking up and saying, I want a different quality of life. I want to work from home. And so a record number of people are actually starting their own businesses. And that could be why you see an increase there in the statistics. And for employers, it's also maybe a reason why it's harder to find people, because people are choosing maybe to work for themselves. So those two statistics kind of match up what we're hearing. So great presentation. I don't have anything else. No other questions, Quentin? You want to end it?
So thank you everybody for joining us. I think as Bella mentioned, we will have this presentation available for rewatch or share with somebody that you may feel it'd be beneficial for. If you have questions about your personal situation, maybe which retirement plan to approach, how to structure your income as far as pass through versus wages, how that might impact Social Security and retirement planning, feel free to reach out to us at any time. We're here to kind of walk you through those options and help guide you towards the best option.
Definitely. And just one more note too, shortly after this webinar ends, you'll be getting an email with a short survey. We'd really appreciate if you'd fill that out for us. We put these webinars on for you, and we'd love to hear your questions and things that might be on your mind that are relevant and timely that we can either make a video series or talk about maybe on our social media, or maybe even create a whole webinar this coming year for it. So we definitely would appreciate your feedback on that. And like Quentin said, if you have any other specific questions, feel free to email us invest@kwbwealth.com. Thanks for joining us today, everyone. Have a great day.